In this video, we're going to introduce the concept of ratio analysis. Now, when we think about analyzing things, here's where I think many beginning business people have some issues, right? And the issues that they have all revolve around confidence. A person who is very experienced or is experienced or has some experience with financial statements in a real business context typically doesn't have this issue, right? They understand the statements, and as students, we could understand the statements. They understand what the information is telling them, and of course, we could understand what the information is telling us. But they've got that experience that gives them the confidence that they can speak about what it means. What does it mean for the company? How can the company fix this? That is really what analysis is all about. You can repeat numbers, right? Profit was this year and it was this. That is not analysis, right? Analysis is a description of what the data means, not what it is, but what it means. So if I were thinking about ratio analysis, I would like to break it always down into three things. The first thing I would like to do is describe what the ratio means, either the category or the individual ratio. What does this metric tell us about the business's or a business's soundness? Then we want to talk about what the number means for this company, right? Tell me, how does this influence managers' decision making, right? How does it affect the bonuses of management, right? How does it affect operations in general? Or how does it reflect operations in general? And then finally, I would like to have some idea of what management needs to do to fix a number that's not good, right? How can I fix it? Sometimes those answers are the hardest because we really don't know most companies. Unless you're inside the company, you really don't know the answer to all those, well, how do I go about fixing things? Because every company has its own life pattern, if you will, to follow. So ratio analysis, we talk about it's a relationship. I refer to it as it's a relative number, right? Relative compared to absolute, right? If I told you that Walmart made $5 trillion and Joe and Mary's discount store made $500,000, would you say, well, Walmart is obviously a much better store because it makes a lot more money? Well, it's bigger, so it's going to have bigger numbers. What ratios do is it provides us with a relative number. It shows us one variable relative to another variable so that we can make comparisons. And we'll see that as we go through some of these examples. So there are three basic types of ratios we can talk about. Profitability ratios, they measure operating success. In some other videos, I've talked about the idea of control. How well does management control the expenses of the company? Because revenues come in, right? You don't want to control revenues, right? We want to control expenses so that we can increase profitability. Liquidity ratios talk about our ability to pay our bills short term. What are the short-term obligations of the company? We have an electric bill that's due. We owe money for accounts payable because we bought inventory. Do we have enough cash to cover those short-term obligations. What are solvency ratios? Solvency ratios measure the ability of a company to survive over a long period of time. I think that tells us a part of the story. Solvency ratios tell us, relatively speaking, how much debt do we have. It can also help us understand whether or not we can pay on that debt. So there is a set of solvency ratios that look at the how much debt do I have question. And we're going to talk about one of those in this video. There are also ratios that measure our ability to make payments on how much debt we have. So it is true that it measures the ability of the company to survive. But from an analytical perspective, we want to just know two things. How much debt do I have? And can I make payments? So let's come back to our classified balance sheet. Here we have Best Buy in years 2016, 2017. You can see our assets, liabilities. Again, we can see that there was a slight increase in assets over the 2 years. Here's the right-hand side of the balance sheet with our short-term debt, long-term debt, our equity section. So we have 2 years of financial statements for the company, and this is the balance sheet. So one of the ratios we can look at is that thing referred to as liquidity. Can we make payments on our current obligations? Well, this starts with the concept called working capital. If you take the current assets of the company and subtract current liabilities, this is what they refer to as working capital. Working capital needs to be positive. If you think about the definition, current assets measures our cash flow, the cash that we're going to have within a year. Current liabilities measures the amount of debts we have to pay in a year. So if you have less cash than debts, if working capital is negative, it means you don't have enough money to pay your bills. And you may have trouble making payments. Doesn't mean I will for sure, but it does indicate that I may have those challenges. Now, again, we want to use, again, this is just a more of a calculation of that. We want to understand our ability to make payments on these obligations. So we have a ratio, right? It's called the current ratio. You take the current assets divided by liabilities. Now here I think you can see the relationship. What is the relationship between those things that will be cash and those things that will be bills? If that number is greater than 1, you have more cash than bills. That's a good thing. So having a number greater than 1 is very important. Now, this text puts this colon 1, like it's 1.43 to 1. We really don't need that to 1 thing, right? We don't need this this colon 1. The current ratio for 2016, 1.43. In 17 it was 1.48. In 2016 it was 1.43. H.H. Gregg was 1.51 in 2000. So H.H. Gregg is slightly more liquid, has a little bit bigger number, not by much, but it has a little bit bigger number than Best Buy. So we would say, this is obviously almost too close to call, both companies have current ratios greater than 1, so it shows they have really more current assets than they have current bills. And that's something we want to look for in our company. What about solvency? Again, our ability to pay interest as it comes due and to repay balances, right? Again, they refer to this as being a measure of the ability of the company to survive for a long period of time, right? Again, there's lots of ratios we can use. The ratio that they choose in this initial analysis is referred to as debt to assets ratio. You take the total liabilities of the company and you divide it by total assets. This tells us, if you remember, the balance sheet is equal, right? So the left-hand side tells us where the money came from. The left-hand side tells me the assets we bought. The right-hand side is where the money came from. So this tells us the percentage of assets that have been purchased with financing long term. So this is total debt divided by total assets. What percentage of the left-hand side of the balance sheet has been financed with creditor money? What percentage? And of course, the bigger the number, the greater the amount of debt that we have. The greater the debt we have, the riskier the company we have. The greater the solvency, when you're measuring solvency, the less solvent you may look because you have more and more debt. So to kind of conclude this, let's talk about debt for a second, right? Is debt good or bad? I mean, most people, because they look at themselves, realize that debt, more often than not, is not a good thing, right? We always seem to have too much on a personal level. But businesses cannot survive without borrowing money, especially large corporations. Debt is used to finance. It's used to buy assets. It's not for operations. It's used to buy assets. Some companies will have great amounts of debt. Others will not. If you don't have a lot of plant and equipment, you're more likely to have less debt, right? Google, other than some buildings, really doesn't have that much in the way of debt or of assets, right? I mean, as far as capital kinds of assets. General Motors obviously is highly capital intensive. So they've chosen to have more debt than anybody else. So when the question comes up, is debt good or bad? The answer to the question is, I don't know, right? It depends on how the company manages that debt. It depends on the assets that they purchased with that debt. If they buy good assets that earn a rate of return greater than the cost of the debt, then they're making profit. They're increasing the value of the firm. So let's just take a real quick look at a couple other statements before we end up this. We can look at the income statement, right? In 2014, Best Buy, $532 was their net income. If we put this in perspective, we can calculate something called earnings per share. It's the net income of the company minus preferred dividends. Most companies don't have those. And you divide that by the weighted average cost of number of common shares. So here we have shares at the beginning and ending. You just find the average number, right? So what is the actual earnings per share for these two companies? 532 divided by this average gives you the earnings per share. Now, what you can also see in year 2013 is they actually have, I'm trying to get this picture here. It's not going to work. Sorry, I apologize. We need to do this calculation. There's going to be a negative number for 2013. Something happened in 2013 that affected the overall profitability of this company. We can also look at the cash flow statement. They have a line item, something called the free cash flow. Now, in your textbook, they use the formula is net cash, right? This is cash from operations. Subtract out capital expenditures, and then subtract out cash dividends, right? So essentially, this tells us how much cash is left over after I've accounted for these types of expenditures, right? The greater the free cash flow, the better. Now, there are other definitions for this, right? There's other definitions, a way to calculate this. If you look at this PowerPoint and you look in the notes section, I have another formula. I don't want to muddy the water too much with this, but we can look and see what the free cash flow of the company is. So after they've paid for all of the bills of operation, after they've bought all the things that they're going to buy, after they paid their dividends, they have $80,000 left over. What could you do with that $80,000? Right? If you had an extra $80,000, what could you do? Right? I could pay off my debt a little bit quicker. Maybe I put some money towards debt. I have to make interest payments. That's not included here, but I have to make interest payments. Maybe I buy back some common stock, right? So there's lots of things that I can do with this free cash money, free cash flow. And investors look at this number, right? They want to understand, how certain is it the company will be able to make payments on their obligations and on the things that shareholders expect to be paid. So again, that's the end of this video. I hope to see you soon. Have a good day.